Hello, I'm Dr. John Prudhont DBA and MBA in Financial Management and Finance, respectively, an entrepreneur, business finance and mergers and acquisitions expert. Cases of unethical action by management and employees can be found in the headlines, and it almost seems impossible to stop. Today, I'll present the sleight of hand of the unethical case study involving Klynveld Peat Marwick Goerdeler, or KPMG, which I will refer to as KPMG's prescience scheme. You see, management at KPMG needed desperately to see into the future, and one longtime manager found the alchemy to do just that for a very short time. First, to put the unethical actions in perspective, a brief overview of the history of KPMG. In 1891, William Barclay Peat, the P in KPMG, took over accounting firm Robert Fletcher and Company and renamed it William Barclay Peat and Company. Then, in 1897, James Marwick, the M in KPMG, formed Marwick Mitchell and Company in New York City with Roger Mitchell. 1911 saw Peat and Mitchell agree to a merger creating Peat Marwick Mitchell and Company. In 1917, Piet Klynveld and the K in KPMG opens accounting firm in Amsterdam. Then in 1953, Reinhard Goerdeler, the G in KPMG, joins Deutsche Treuhand Gestalt. In 1978, Peat Marwick Mitchell Company International is renamed Peat Marwick International, PMI. In 1979, saw DTG merge with McLinnock Main La France, forming Klynveld Main Goerdeler, KMG. Then in 1987, KPMG Network was created when Peat Marwick International and Klynveld Main Goerdeler merged. 1987 also saw David Middendorf, who is the star bad actor in this case study, start as an auditor for Peat Marwick Mitchell and Company. SOX created the Public Company Accounting Oversight Board, the PCAOB. The PCAOB inspects audits by large accounting firms each year. In 2013, the PCAOB identified severe discrepancies in 48% of KPMG audits. Then again in 2014, the PCAOB identified severe discrepancies in 55% of KPMG audits. In June 2014, Middendorf was promoted to the position of National Managing Partner of Audit Quality and Professional Practice of KPMG. In 2015, Palantir Data Analytics Company is hired by KPMG to predict PCAOB audit selections. Then in February 2016, the Securities and Exchange Commission, SEC, has what it refers to as a come-to-Jesus meeting with KPMG. Now that you know a little about the historical timeline of KPMG, just what were the unethical business practices? PCAOB Ethics Code number 9 barred PCAOB staff hired by KPMG or any other company from disclosing confidential PCAOB information to KPMG or any other outside firm. KPMG partners received insider information on PCAOB inspection selections from PCAOB employees as follows. In May 2015, former PCAOB Inspector Brian Sweet was hired by KPMG as a partner. Before he left the PCAOB, Sweet had downloaded confidential PCAOB information including inspection planning information, inspection guides and manuals, lists of inspection selection criteria, and a list of KPMG engagements selected for inspection in 2015. Tom Whittle, KPMG's national partner in charge for quality management, asked Sweet for the inspection list for 2015, and Sweet provided it to him. Sweet then shared confidential inspection selection factor information from PCAOB to the KPMG manager managing the predictive analytics project with Palantir. Next, KMPG partner David Britt asked Sweet to obtain the list of bank audits selected for inspection. Sweet then had former PCAOB colleague Cynthia Holder email a confidential document from PCAOB to him and leave out a critical comment involving a KPMG engagement inspection, which he did on Sweet's recommendation. Holder was hired by KPMG as executive director of its inspections group. Next, Jeffrey Wada, a PCAOB employee and friend of Holder who wanted a job with KPMG, provided her with a partial list of PCAOB's 2016 inspection selections. Wada's, quote, grocery list, unquote, was shared with Holder, with Sweet, who shared it with Whittle, Britt, and Middendorf. Middendorf, Whittle, and Britt used the list to have Sweet and others do, quote, stealth reviews, unquote, of the work papers for a number of engagements on Wada's list. In January 2017, Wada provided Holder with a new preliminary and final list of inspection selections.
Middendorf then contacted his boss, Scott Marcel, Vice Chair of Audit for KPMG, and told him that he possessed the list of PCAOB audit targets. Finally, Middendorf and Marcelo did not contact KPMG's Chief Legal Officer to tell him about the confidential PCAOB 2017 audit list information from Suite until February 13. Then the whole scheme imploded. Why were these practices violations of ethical behavior when placed in the context of ethical standards? A foundational ethical rule for business is Hippocrates' do no harm principle. The harm done to the reputations and livelihoods of all co-conspirators and the financial penalties assessed against KPMG and its shareholders demonstrate that the actions violated this ethical premise. Under the normative moral theories like utility theory and moral relativism, essential ethical measurement of right versus wrong, stealing information from PCAOB by KPMG to provide a competitive advantage, appears to sit soundly on the wrong side. Under teleological ethics or utilitarianism, violating the law is okay if the benefit exceeds the harm. The benefit from stealing, sharing, and using confidential information from the PCAOB by KPMG employees did not exceed the resulting damage to KPMG and the public. From a Rawlsian liberal theory of justice, it is not ethical to arrange society unfairly, and KPMG employees obtained an unfair advantage through collusion. Finally, the actions of the co-conspirators violate the virtue theory of business ethics due to the failure of the KPMG and PCAOB employees to live up to the duties owed to society as a whole. How did leadership at KPMG influence this behavior? Leadership may have contributed to an unethical reaction due to the perceptions that PCAOB auditors focused on finding errors and had a lack of adequate comprehension of firm audit structure. Unrealistic, amorphous leader goal orientation to reduce the audit failure rate and deflect penalties by KPMG International might have encouraged unethical actions by Middendorf. Business network theory suggests interactions across organizational boundaries from PCAOB staff to KPMG to PCAOB staff and back again formed avenues for unethical practices to travel. Somewhat surprisingly, organizational leadership did not have adequate systems in place to dissuade an unethical organizational climate at KPMG International. What are some of the behavior's cultural, environmental, and legal implications? From a cultural perspective, the stress and pressure of PCAOB's inspections negatively affects the retention and recruitment of good business-minded people. KPMG's partner compensation system encouraged immoral behavior to combat a negative PCAOB audit result due to potential loss of income and employment. The social pressure of PCAOB board and SEC criticism and threats encourage an environment of moral ambiguity due to the crisis of needing to fix cryptic audit performance quality results and the danger of being banned from performing public company audits. A culture of informal systems of collusion and tacit agreement between management-level employees at both the PCAOB and KPMG to revolving door transfer of proprietary information from the PCAOB was allowed to exist. KPMG is headquartered in Switzerland. Institution theory suggests that unethical Swiss business and government culture driven by corrupt practices that are cross-culturally sensitive can result in moral ambiguity. For example, bribes paid outside of Switzerland by Swiss companies were tax-deductible until 2004. From an environmental perspective, the KPMG organization is the umbrella brand that member firms operate under. Each firm is a separate legal entity and generally locally owned and managed. Each member firm is theoretically insulated from losses from other member firms and KPMG International's actions. What can we see as the impact of the unethical behavior on individuals? The very public termination of the 6 KPMG bad actors for violation of the firm's code of conduct reinforces the board of directors' commitment to enforcing penalties against employees who choose unethical affect heuristics based on processes and results. The impact of the unethical behavior on the organization was that KPMG Global Board organizational culture governance changes were implemented to form a common set of values, standards, and service quality for member firms. On a society-wide level, the unethical behavior undermines firm and societal trust in the quality of financial audits and accounting firm business dealings. And what were the events, outcomes, and the consequences of the unethical behavior for the 6 participants? On April 11, 2017, KPMG fired Scott Marcello, David Middendorf, David Britt, Tom Whittle, Brian Sweet, and Cynthia Holder including the head of the U.S. audit practice. According to Kaiser et al., KPMG later paid a civil monetary penalty of $50 million to settle an SEC enforcement action related to this and another case involving continuing professional education. In March 2019, Middendorf was criminally convicted of wire fraud and conspiracy to commit wire fraud, and he was sentenced in September 2019 to 1 year and 1 day in prison, followed by 3 years of probation. How about the consequences for the other co-conspirators? In October 2019, Jeffrey Wada was sentenced to 9 months in prison and 3 years of probation. In August 2019, Holder was sentenced to 8 months in federal prison, followed by 2 years of probation. In October 2020, Britt was sentenced to home confinement for 6 months, to be followed by deportation to his native country, Australia. In December 2020, Whittle, who testified as a witness against Middendorf, was sentenced to 2 years of probation. In November 2020, Sweet, who testified as a witness against Middendorf and Wada, was sentenced to 3 years of probation and restitution. So, were the punishments fair? A justification of the fairness of the punishment of the managers and employees is as a deterrent to combat moral hazard behavior. Since the actors were all held personally responsible for their actions, taking chances for individual gain, thinking that the shareholders will cover any penalty, is parried. It is challenging to justify the financial penalty against KPMG as an organization, and especially to its shareholders, since the unethical behavior was practiced by only 6 out of the over 230,477 internationally based employees. The fact that OCAIB management failed to have data controls in place and had forced to reduce the potential for its employees to trade proprietary information with its audit subjects outside of the organization for financial gain, and that it was not subject to monetary penalties as an incentive to improve its internal controls, similar to KPMG, seems to fail ethical fairness measurements. KPMG can implement the following policies and procedures to discourage future occurrences of similar unethical behavior. KPMG should implement a policy barring revolving door appointments. KPMG should also implement a tiered reward system to compensate audit staff for meeting metrics involving quality and passing PCAOB inspections, which could alleviate the implicit pressure on management for unethical alternative methods to pass examinations to be developed and implemented. KPMG should add a chief ethics officer who reports to the board of directors to provide a point of contact for employees and partners to determine if proposed courses of action are ethical. Supervision of partners' activities by the CEO of KPMG and PCAOB's review of its employees' access controls to digital data and phone communications with audit staff by PCAOB staff should be implemented. Effective control management and implementation should reduce potential unethical data sharing. KPMG's Global Code of Conduct and anti-bribery and corruption ethics training programs and internal penalties for violation of ethics policy should be reviewed quarterly, addressed, monitored, and implemented effectively to combat unofficial, informal, and unethical behavior, to reinforce official ethical norms, and to support moral development.
I'm Dr. John Prudhont, Doctor of Business Administration and Financial Management and Master of Business Administration and Finance, entrepreneur, finance, business administration, and M&A expert. Thank you for taking the time to learn about the importance and application of competitive advantage for businesses. Please contact me at johnprudhont@gmail.com with questions or to book me for speaking engagements and appearances.